The Fed just came out and gave their July 2023 meeting report, and they actually did go ahead and raise by 0.25%, also known as 25 basis points. 99% of all expectations were for the Fed to actually raise by that 0.25%, and they did that. The market was correct. We had that priced in already. So the market isn't really moving all that much after hours. But Fed Chairman Jerome Powell did say one thing that could affect stocks as long as all the way through 2024 into 2025. And I want to talk about what that thing is and how to prepare yourself with a little classic don't fight the Fed advice. But first, if you're new here, I'm Austin. I'm a co-owner of cloudmusicsuite.com, and I'm a stock market investor, of course. If you're new to the channel, welcome. Go ahead and hit that subscribe button. If you're a returning subscriber, thank you so much for being subscribed. We just passed that 1,000 subscriber mark, so that's super exciting. Thank you to every single person who is subscribed. As a thank you for those who just clicked that button, here's a picture of both my kitty cats who are actually right off camera to my left, Millie and Luna. Millie's the gray one, Luna's the brown one. They thank you for subscribing. Okay, let's get into this Fed news. So the Fed did actually raise by the 0.25%, also known as 25 basis points. So we're now in the range of 5.25 to 5.5. which is the highest we've been in over 22 years. And relative to the zero rates that we've had and the really low rates we've had over that time, this is a substantially elevated rate from what most current investors are used to dealing with. Past that 25% basis point increase, they really didn't say anything all that crazy in the announcement. In the announcement, it was pretty much all the same language as they've been using for the last 6 to 7 months. Hey, we're not at our target yet. We need to get to 2% inflation. That's their goal. Yes, of course, we're getting closer and closer to that, with our most recent CPI print being a 3.0 on a year-over-year basis. So we'll see what happens with the next CPI print, but I would bet we're going to keep on inching down slower to that 2% goal. And then once we hit that, the Fed is probably going to pause for a considerable amount of time. And this is that one thing in the press conference at the end where the market started to get a little shaky right after Jerome Powell said that they might not see the 2% inflation goal reach its target until 2025, which means we're going to raise up to this 5.25 to 5.5 range, probably keep it there for a very long period of time, and that period of time was believed to be somewhere around 6 to 12 months, which would put us in mid-2024 or potentially even early 2024 for a rate cut happening. But the commentary of the Fed was that we're probably not going to get to that 2% inflation goal, and then they didn't say this because this would be way too bullish for the market, but once they reach that 2% goal and they've held rates there for a while, the next logical move is to cut rates so that the financial system doesn't stay continually stressed as long as that inflation rate on a year-over-year basis stays around the 2% mark. If we have a Fed that goes ahead and keeps rates at either 5.25 to 5.5 target range or 5.5 to 5.75 target range, and they keep it there for the entirety of the rest of 2023 and 2024, that's 6 quarters straight of these extremely elevated rates. There are countless companies that retail investors love to look at that I don't think can weather the storm of those high rates, because so many of the companies that people end up looking at are massive money losers. So what they're going to have to do over time is either take out more debt at the extremely high interest rates that we have right now, which would be terrible for their EPS situation, which would put them in a weaker spot as we move forward, which is not what we want from a company we're investing in. We want a company to be in a stronger spot quarter in, quarter out, from a balance sheet perspective, from an EPS perspective, from a free cash flow perspective, etc. Or if they're not taking on more debt, in order to raise cash, they're going to end up diluting you as a shareholder, which means the total number of shares outstanding increases. If the market cap stays the same, total number of shares outstanding increases. Since that's on the denominator of that fraction, then what happens is share price goes down, and that hurts investor returns in a massive way. So a couple actionable tips as we're looking out there for what stocks to buy. One, if you can't decide what stocks to buy because you don't feel comfortable with your analysis, just buy the index. Don't be freaked out and not be a buyer right now. But if you can't figure out how to analyze a company in the sense that they're going to be okay to weather high interest rate times, at least buy the index. But as it relates to picking stocks, we want strong balance sheet companies that could easily pay off their debts with the cash that they have on hand and their other short-term investments. That would be ideal. You can have a company that has a little bit more long-term debt than they have cash. That's still a strong cash position. That's okay. But the higher the ratio of cash to total debt, the better for you as the investor and the more comfortable you are holding shares of that stock, because that company is not debt ridden and they're not going to feel the pain of the high rates as much as another company that has loads and loads of debt. Also, as a stock picker, it's important to pick EPS positive companies, especially in this high rate time, so that the company that you're picking can fund its operations and fund its future growth from its operations. We need income from operations to be the money that we're using to flow into R&D and to flow into product expansion and to flow into marketing expense. We don't want a company that's taking on debt or diluting shareholder equity in order to fund their business growth. Most people watching this video have at least one stock that's a money loser on the bottom line, that's EPS negative. I'm not saying you should sell that company right now. Just be aware, make sure that company's in a position where they're getting stronger and stronger position, closer and closer to EPS positive, because if profits aren't on the horizon, it's going to get more and more difficult for them to fund their operations and grow their business over time, which is what you want as a shareholder, because that's going to contribute to your overall return. And then lastly, make sure your conviction around your stocks is focused on fundamentals and it's not focused on hype. With the markets up so much year to date, a lot of people are getting greedy and there's a lot of hype out there and there's not a ton of focus on fundamentals. Please do make sure you check in on the fundamentals, especially as we move through these high rate environment times. If rates stay elevated all the way through 2024, you're not going to want to be in an EPS negative company. You're not going to want to be in a company with a bad balance sheet. You're not going to want to be in a company that has negative free cash flows on a quarterly basis. So stay smart out there. Make sure you're looking at the fundamentals. I hope you're making tons of money this year, and we'll see what happens over the next 6 months as 2023 plays out. What do you think about this most recent Fed decision? Do you feel like they were pretty dovish? Do you feel like they were pretty hawkish? What's the next plan for the Fed? And do you have any hot takes about the commentary they had? I want to hear about it in the comments. It's one of my favorite parts of posting here on YouTube, is looking at the comment section, having some conversation with you guys. So I want to hear about it. Put it down there in the comments. I appreciate you for being here and have an amazing day.